If you're getting ready to go all in on the next big investing trend for 2026, stocks, crypto, AI picks, whatever, listen. Because most people don't lose money in investing from bad picks. They lose money because life happens first. A medical diagnosis, a job loss, a disability, a family emergency, and suddenly the investment account you swore you'd never touch becomes the emergency fund. So today, I'm going to make a strong claim, and I'll back it up logically. Before you chase growth, you protect your foundation. That means life insurance, especially with living benefits, before the hype investing season begins. And yes, we'll also cover a controversial topic: why maxing out your 401k is not always the smartest first move, and where an IUL can fit and where it doesn't. Not financial advice. Education only. Talk to a licensed professional. The 2026 problem: people will invest hard without a safety net. Let's be real, 2026 will be loud. You'll hear, "This is the year to go aggressive. Rates are changing. Buy now. This index stock/strategy is the next big thing." But here's the issue. Investing assumes you can stay invested. And that's not guaranteed. If you get sick, you can't work. Someone in your family needs care. You face an income disruption. If your plan is, "I'll invest first, then later, I'll protect myself," that's like building the second floor of a house before pouring the foundation. The core argument: protection creates the ability to invest consistently. Protection is not a nice-to-have. It's what makes your investing strategy durable. Because the real wealth-building secret isn't picking the best fund. It's this: the person who invests consistently for 20 years beats the person who invests perfectly for 3 years and then stops. So the first question isn't, what should I invest in for 2026? The first question is, what could force me to stop investing? And how do I insure against that risk? That's where life insurance with living benefits enters the conversation. What living benefits actually mean? Simple explanation. Most people think life insurance only pays when you die. Living benefits, depending on the policy/riders, can allow you to access money while you're alive if you experience certain events, often like critical illness. Example: cancer, heart attack, stroke, varies by policy. Chronic illness. Example: inability to perform certain activities of daily living, varies by policy. Sometimes terminal illness features exist too, policy dependent. Important: these riders have definitions, rules, and limits. Some may have waiting periods and specific eligibility criteria. But the big idea is this: living benefits can turn life insurance from only for death into a financial shock absorber. Real talk scenario. Why this comes before investing. Hype. Let's do a quick story. You're investing hard. You're disciplined. Then a diagnosis hits. Or you're out of work for months. What do most people do? They liquidate. Brokerage accounts, retirement accounts, sometimes with penalties/taxes, savings they were building for the future, and the worst part: they often sell when markets are down, because the emergency doesn't care about market timing. This is why protection matters first. It reduces the odds you'll be forced to sell your future. But isn't life insurance a bad investment? This is where closed-minded people shut down. So let's address it fairly. You are correct that life insurance is not the same as a brokerage account. It has costs. It's not for everyone. It requires proper design and management. But here's what's also true. Not everything in your financial plan is an investment. Some parts are. risk management, liquidity planning, tax planning, legacy planning. You don't buy homeowners insurance hoping your house burns down. You buy it because the consequences are too big to self-insure. Let it sink in. You don't buy homeowners insurance hoping your house burns down. You buy it because the consequences are too big to self-insure. Life insurance, especially with living benefits, plays a similar role. Protect the income engine, protect the family, protect the plan. Now, the 401k conversation. Careful, balanced, honest. Let's tackle the 401k. First, a 401k is a powerful tool. And for many people, the employer match is a must. Also, for 2026, the IRS increased the employee deferral limit to $24,500, with additional catch-up provisions depending on age and total plan contributions up to $72,000 employee plus employer for many plans. So why would anyone say maxing out your 401k is not good? Here's the more accurate statement. Maxing out your 401k can be suboptimal if it causes you to ignore protection gaps, no life insurance, no living benefits, underinsured, liquidity gaps, no emergency fund, tax diversification, all money in tax-deferred bucket, access timing, retirement accounts are designed for later, not sudden life events. A 401k is primarily a retirement accumulation tool. It is not designed to be your life happens fund. Why 401k money can be trapped at the wrong time. With a 401k, access is generally restricted until retirement age, and early withdrawals can trigger taxes penalties depending on circumstances. Even if you can borrow from a 401k, that loan can come with repayment requirements, may become due quickly if you leave your employer, and can disrupt investment growth. So the risk is not 401k is bad. The risk is, if all your financial power is locked behind retirement rules, life events can break your plan. Where IUL fits and what it actually is. Now let's talk about Indexed Universal Life, IUL. An IUL is permanent life insurance that can build cash value with growth linked to an index formula and typically has downside protection in the crediting mechanism, often a flaw. But upside is limited by caps participation rates, and it comes with policy costs. This is crucial. An IUL is not better than a 401k. It's a different tool with different strengths and risks. The strongest comparison, 401k versus IUL. Without hype, let's compare honestly. 1. Purpose 401k. Retirement investing vehicle, IUL. Life insurance first, with cash value, potential second. 2. Liquidity. Access 401k. Restricted, rules-based access, IUL. Access to cash value via policy loans, withdrawals. Rules apply. Policy must be managed to avoid lapse, MEC issues. 3. Tax treatment. 401k. Tax deferred, taxed later. Unless Roth 401k. IUL. Cash value grows tax deferred. Policy loans can be tax-advantaged if structured properly, but not magic, and mismanagement can create tax problems. 4. Risk and return. Reality. 401k. Market risk. Higher upside, higher downside. UL. Downside protection in crediting, but upside constrained by caps/participation and costs can reduce performance. 5. Living benefits. 401k doesn't come with living benefits. IUL can include riders for chronic/critical illness, depending on product design. So the winning tool depends on what problem you're solving. The persuasive, closed-minded point. You're not choosing one, you're building a system. Here's the line that breaks the debate. A 401k is great for retirement, but it doesn't protect your retirement plan from being derailed. That's what protection does. And if you're thinking, I only want investments that grow, I get it. But the truth is, the best financial plans are not built on growth alone. They're built on resilience. Resilience is what lets you keep investing through recession, layoffs, health surprises, family emergencies. Protection gives you the ability to stay in the game. The proper order of operations, what to do before 2026, investing hype. If you want a smart framework, emergency fund starter, even small, high-interest debt strategy, foundational protection, life insurance needs, plus living benefits if appropriate. 401k, match, often priority because it's immediate ROI. Then decide. Additional 401k contributions versus Roth, IRA versus brokerage versus IUL, based on goals, taxes, risk tolerance, time horizon. And yes, 2026 rules also include changes impacting catch-up contributions for some higher earners, pushing catch-up dollars into Roth treatment in certain situations. That's another reason to plan strategically instead of blindly maxing. The honest warning: if you're considering an IUL, here's what you must know. Policy design matters. Funding level, costs, duration. There can be surrender charges early on. Cap rates, participation can change. Loans must be managed. A policy can lapse if mismanaged. This is not a set it and forget it product. If someone sold you IUL as guaranteed high returns, better than everything, no downsides, that's a red flag. But if it's positioned correctly as protection plus tax-advantaged supplemental strategy plus living benefits when available, then it can make sense for certain families. So here's the question I'll leave you with. Before you invest for 2026, what happens to your plan if life hits first? If the answer is, I'll cash out my retirement account, then your first move isn't picking a fund. Your first move is building protection and resilience into your system. If you want, we can help you understand how much protection you actually need, how living benefits work on your specific product options, and whether an IUL is appropriate or not based on your goals.